This past week, the Wall Street Journal ran an article titled "The Rise of America's Young Socialists: From the 2008 Financial Crisis to Mamdani." In my next post on housing, we'll see what really caused the great financial crisis. But first, this week, we must understand why our housing markets worked so well for so long before suddenly going off the rails. Hi, I'm Todd. In my early 40s, I retired from a successful career in investment banking to focus on my family and love of investing. Within a short period of time and based entirely on my own research, I made more money investing than I had saved during 20 years of working at the day jobs, which allowed me to devote myself to deeply held interest in economic history and led to my first book, which was published last year. These podcasts and my free Substack newsletter are my way of passing on some of what I've learned along the way. If you're interested in balanced, factually supported commentary for a better future, you've come to the right place. After a short break, we'll take a stroll down housing's memory lane to help us understand why, historically, our housing markets worked so much better than they have in recent years. Recently, a lifelong friend and I made our annual trip back to Kinnick Stadium to catch an Iowa football game. We stayed in Cedar Rapids at Bill's childhood home, which is located just a few blocks from the two homes that I grew up in, which were more or less across the street from one another. Walking along Ridgeway Drive and then up Forest Drive toward my old grade school, I was struck by how my lower middle class parents, my dad was a young high school football coach and teacher, were able to afford nice homes in neighborhoods that also included the residences of named partners in the city's two largest law firms, the owner of the local Chevy dealership, and other successful executives. The affordability of this era enabled our small family to build some modest wealth during these years. In addition, it afforded me with the opportunity to grow up in a socially and economically diverse environment. Indeed, Bill's dad was a lawyer and later a judge. Another long-term friend was the son of the named partner in one of the law firms mentioned above, and the father of a third buddy was a successful executive at Cargill, a large multinational corporation. Like many others, my mom stayed home and neither of my parents had any family money, which means that the affordability of these homes was based entirely on the market's remarkable ability to balance local incomes with local interest rates and mortgage payments and home prices. And our experience was far from unique. In fact, this is why legendary stock picker Peter Lynch once recommended, before you do invest anything in stocks, you ought to consider buying a house, since a house, after all, is the one good investment that almost everyone manages to make. End of quote. Let's take a look at why housing worked so well for so long during this period. Just a note, portions of this are excerpted and adapted from my book, 2008, What Really Happened: Understanding the Great Financial Crisis. For roughly a century prior to the liftoff of the housing bubble in 1997, our markets were characterized by a number of critically important, if underappreciated, factors. For one, housing markets were primarily local and regional. A second key factor was that home prices basically tracked inflation during this century. And third, homes were financed with long-term mortgages with interest rates that typically exceeded the rate of home appreciation. Now let's look briefly at how each of these characteristics contributed to the healthy housing markets that existed during this long period of time, beginning with the local and regional nature of the markets. While home prices generally tracked inflation, housing markets tended to be local and/or regional in nature when it came to deviations from this overall trend. A boom and bust cycle in, for example, the oil patch during the 1970s and 80s might drive pronounced swings in Dallas's home prices as oil-related incomes rose and fell, but it would have little impact in markets like Des Moines. This characteristic was so predominant for so long that almost all observers came to believe housing was more or less immune to a national boom and bust cycle. This belief was so widely held that when a national bubble eventually did develop in the late 1990s and early 2000s, everyone from first-time buyers to large, supposedly sophisticated financial institutions were caught off guard. Now, in addition to this, local and regional institutions, such as banks and savings and loans, were the primary sources of housing finance during this long period. In other words, federal agencies played only a minor role. But as evidenced by the post-World War II housing boom, the minimal role of federal agencies did not keep the industry from growing substantially in the post-World War II years. In fact, overall mortgage debt outstanding grew from a little over $70 billion in 1950 to $475 billion 20 years later, which was a growth rate of about 10% a year, which was over 50% higher than the overall growth rate of the economy during this time frame. Okay, so to summarize, home prices and home markets were largely local and regional in nature, and even though most financing was also local, it didn't keep the housing markets from growing at highly attractive rates throughout this period. The markets grew much faster than the overall economy. So the second key thing that we talked about was that home prices basically tracked inflation. An index is a measure used to analyze changes in prices for an aggregate group such as homes over time. Nobel Prize-winning economist Robert Shiller's index of real, which means inflation-adjusted, national home prices shows that home prices basically tracked inflation for a century. In 1897, the real home price index was 107, and just before the bubble started, the inflation-adjusted index in 1997 was at 114. This means that nationally, annual home price increases were only a tiny fraction over the rate of inflation for over 100 years, or they grew at only a tiny fraction over the rate of inflation for 100 years. Now, just to be clear, this means that during a period of, say, 3% inflation, we would expect home prices to go up about 3% a year. And during higher periods of inflation, like in the 1970s, home prices would be expected to grow even faster, or about in line with these higher rates of inflation. Now, while some supply-constrained markets like San Francisco might grow more rapidly than inflation over time, for the nation as a whole, we would expect that prices would generally track the overall rate of inflation, which is what happened for this century. Most importantly, because incomes, interest rates, and building costs all tend to move more or less in line with inflation over time, this function of our market-driven system during this era helped keep housing prices in line with what people could afford to pay given their income and prevailing mortgage interest rates. Indeed, this is why my parents were able to afford homes in nice neighborhoods even on my father's modest income. Now, all of this raises an important question for the young socialists in the Wall Street Journal article cited earlier. If capitalism is the problem, as the socialists and their teachers all believe, then why did our housing markets work so well for over a century when government played a much more limited role in the housing markets than it has over the past few decades. But this is starting to get ahead of things. So let's return to the third key element of the long golden age of housing, which is that mortgage interest rates exceeded home appreciation. Throughout this period, the basic ownership model involved financing a large portion of a home's purchase price with a long-term fixed-rate mortgage. Before the inflation of the late 1960s and 70s, this might mean buying a home whose value was growing at around 2 to 3% and financing it with a 30-year fixed-rate mortgage carrying an interest rate of 5 to 6%. Periods like this, when the interest rate exceeds the rate of home appreciation, greatly diminish the investment return that people earn on their down payments, which is otherwise known as their equity investments in their homes. During such periods, people still buy homes because of cultural norms and lifestyle choices, the tax deductibility of interest, of mortgage interest, which lowers the effective rate on the loan, and because of the memory of past periods when home prices appreciated more rapidly. Now, after the Great Depression, which ended in the 1940s, most people were highly skeptical of investing in stocks, and during this time, home ownership also served as something of a forced savings program. Homes appreciated slowly, while mortgage payments gradually reduced loan balances, and over time, the equity value in homes slowly increased. Furthermore, home buyers who locked in long-term fixed-rate loans during the 1950s and 60s later benefited enormously when the inflation of the 1970s pushed nominal home prices up much more rapidly than had been expected. But there was also another side to the 1970s. Mortgage lenders who owned long-term fixed-rate loans with rates that were locked in at 5 to 6%, even as the inflation of the era pushed market interest rates well above these levels, were big losers. Rising interest rates caused lower yielding mortgages to decline in value, which meant the value of the assets on these mortgage lenders or these savings and loans books were dropping, even as their obligations were fixed, which squeezed their equity value. And indeed, the inflation of the 1970s basically bankrupted the entire savings and loan industry. Now, feeling once burned and twice shy, lenders then pushed up long-term interest rates to protect against a recurrence of these circumstances. And even as late as the early 1990s, when inflation finally dropped back down below 3%, long-term mortgage rates still averaged around 7.5%. This continued to hold housing market appreciation in check until home prices suddenly started to spike upward in 1998, which was the beginning of the bubble that brought an end to the long golden age of housing and which will be the focus of our next housing discussion. Let's take a break, and then we'll come back to wrap things up. Okay, to summarize what we've covered today. For nearly a century, our market-driven housing system did a remarkable job of keeping the key factors for home affordability, home prices, mortgage interest rates, and incomes aligned, and also of preventing against national booms and busts. Which is why, because my parents bought homes during this period, why they were able to afford homes in nice neighborhoods, even on a young teacher's relatively early or starting salaries. This is also why star stock picker Peter Lynch recommended in the late 1980s that most people buy a home before considering investing in stocks. The smooth functioning of these markets through two world wars, the Great Depression, and the great inflation of the 1970s raises tough questions for young socialists who have been taught that recent problems should be blamed on capitalism. Rather, this history suggests that the housing bubble, the financial crisis, and our recent affordability problems are the result of some new dynamics that brought the long golden age to an end, an issue that we'll return to in future posts. Today, we face important challenges, like home affordability, but none that are greater than those we have overcome time and again throughout our storied history. Here's to hoping your day is as bright as America's future. I'm Todd. Thanks for your interest. If you found this helpful, please subscribe and recommend it to at least one other person. And if you'd like to learn more and find links to my free On Wealth and Progress newsletter and my book, please visit my website, toddsheetswriter.com. Thanks again, and have a great day.